Thank you, everyone, for joining the webinar on this topic. We're only literally a month away from end of financial year for current 24-25 personal financial year. I know some of you might have the company year end as 31st of March too. So this is just to give you a bit of a revamp on what you should be doing within this month, because the time is very limited. Because I'm sharing the screen, I can't see the chat. If you have any questions, please unmute yourself and ask if you don't mind. Thank you. So the content of this webinar today is we're going to look at an overview of personal taxes in UK and the taxable income and the table, understanding the tax brackets and the income levels, some of the tax relief that you can utilize by 5th of April 2025. And special look on tax relief such as CIS, CIES, and BCT schemes, and some special tax implications and the self-assessment filing requirements you should be aware of. Overview of personal taxes in the UK. So when you talk about personal taxes, obviously there are two kinds of taxes. One is the PAYE tax, where you pay on your payroll income, and if you are not earning everything through a PAYE, if you're a director of a company, or if you're a sole trader, or if you're a landlord, etc., you pay the taxes through a system called self-assessment. So you're self-assessing yourself about your taxes and paying that tax to HMRC. So HMRC use this system to collect the income tax from individuals annually. So the financial year ending 24-25. So don't ask me why it's from 6th of April to 5th of April. It is not straightforward, but in UK we like to do everything very differently. So that's why it starts on 6th of April, finish on 5th of April. The self-assessment for that period needs to be submitted by 31st of January 2026. But do not wait till very last minute, because that does cost a lot of grief to my team. It's always better to file your tax return soon after 6th of April if you have all the paperwork. So self-assessment, who needs to file? As I told you, if you're self-employed earning more than £1,000, you need to file. Partners in business partnerships, some people run businesses as partnerships. You need to file partnership return and partnership accounts to HMRC by 31st of Jan. Company directors, especially if you have dividend income, etc. Individuals with rental income or foreign income. Foreign income is another big topic, because people assume if they pay taxes in the foreign country, they don't have to pay tax in UK. That's exactly wrong. You need to pay and file UK taxes on your global income in UK. There might be certain double tax treaty agreement available there for you to reduce that bill, but there's always a requirement you to disclose that income in UK. And those who have income above 150,000 need to file a tax return. Also, people who have child benefit, because if you earn more than 50,000, you need to repay some of the child benefit. So then you need to file a tax return. And also, if you have any capital gain, such as if you dispose shares, if you dispose cryptos, etc., you need to file a tax return. Taxable income is the portion of income that is subject to income tax. It's calculated after all your allowable tax deductions and exemptions. So taxable income examples are salary, bonus, rental income, self-employment income, foreign income, everything that I covered on the previous slide. Understanding the tax brackets, that's really important. So if you earn up to 12,570, you don't pay any income tax. And if you earn savings up to 5,000, that means 12,570 plus 5,000 of savings, again, you don't pay any income tax. Basic rate taxpayers pay 20% tax, and then your savings is only £1,000 allowance. And higher rate taxpayers pay 40% tax, and your savings tax-free allowance becomes £500, and additional tax rate payers pay 45% tax, and they do not have any savings allowance. And the dividends on the other side, so if you're a basic taxpayer, you pay 8.75% dividends, and if you're a high taxpayer, you pay 33.75, and if you're an additional rate payer, you pay 39.35.
Vijay, can you elaborate on what you mean by savings?
So if you have savings income, for example, if you have bank savings or foreign savings, If you only utilize your personal allowance on the first 5,000 on the savings income, you do not pay any tax.
Okay.
But if you are a basic rate taxpayer, if you earn interest of 5,000 as an interest income as on your savings, on 1,000 pounds you don't pay any tax, but other 4,000 you pay 20% tax. That's how it works. Is that clear? And this, when I say this savings interest, these are all non-ISA. So if you have your interest or capital gains on your ISA savings, you do not pay any tax on your ISA savings, right? Because ISA is not taxable income.
Okay.
Thank you. Tax reliefs and allowances. So personal allowance, I covered that point. So, first 12,570 is tax-free. But if your income is above 100,000, every £2 that you earn, you will lose £1 of your personal allowance. So if you earn 110,000, your personal allowance will come down by 5,000. So from 12,570 to it will become 7,570. So if you earn more than 125,000, 140, basically you do not have any tax-free allowance. So you'll pay the starting rate at 20,000 and then, 40% thereafter sort of thing. So it's very important if your income is like 105,000, 110,000, whether worth putting that extra money into the pensions or something. So you bring down your total income to 100,000, which means you have the full personal allowance of 12,570. Marriage allowance is allowed for people if you are married and one of you work and one of you don't work. Your married partner can transfer 1,260 pounds of personal allowance to yourself. The main thing here is you need to be a basic taxpayer to utilize this. If you're a high taxpayer, unfortunately, you can't utilize this. Blind personal allowance, there's a special allowance for anyone who has, registered as a blind or severely sight impaired. Their limit is increased to 3,070 per year. Annual exempt allowances, so these are the capital gains. So you have trading income or normal PAYE income. Top of that, you might have a second property that you want to sell. You might have some assets you want to sell. You might have investment in gold that you want to sell. So if you make income on that one, the first 3,000 is tax free. But if you make more than 3,000, you have to pay capital gains tax on those ones. So very important to notice that it was 6,000 last year. It's got reduced to 3,000 to 24-25. Rental room relief. So if you're renting if you have a lodger in the house, or if you're renting a room in your house, you can earn 7,500 tax free as long as they are within your premises and they are sharing the same household as you. Pensions, it's one of the main tax savings in UK at the moment. So if you pay into pension up to 60,000 per year, you do not pay any personal tax on it. And the amount, you can also go back for previous three years and calculate that amount or increase that amount. So it's important to know that if you are a director, shareholder in a company, if your company is making significant profits, it's worth considering paying lump sum from your limited company to a pension pot, which will save a significant amount of corporation tax. Jumping down to gift aid, so this is the donations you make for any of the charities. So if you pay into charities, you can claim 25 pence extra for 1%, £1 of donation you make. So any donations you make, keep a track of it and report that on your tax return, because you do get some tax benefits back of it.
Vijay, Rajiv here.
Hi, Rajiv.
Hi. Just a very small query regarding the pension. How can you elaborate more about in context of inside and outside contract perspective, the pension contributions, please?
Yeah. So sorry, Rajiv. Thanks. Good question. Outside is quite straightforward, Rajiv. So outside, you pay from your limited company directly. So it goes as an employer contribution, right? So when you pay from outside, money comes to the limited company and you pay into pension. So you save corporation tax. Quite straightforward. If you're on an inside IR35 role, that depends on the umbrella company to umbrella companies. So some umbrella companies let you do an employer contribution. So you work for £500 a day. If you work 20 days, £10,000 is your monthly invoice. From the 10,000, you can ask them to pay 2,000 to the pension pot. So you're left with 8,000. and that 8,000 you pay, both employers NI and employees NI because they're working through umbrella company. But you save money because the calculation is based on 8,000 rather than 10,000. Some umbrella companies do not allow that. So what they do is they still calculate employers and employee contribution on the 10,000, and they let you do salary sacrifice from your gross salary. So it's important you go back and check with your umbrella company. The first one is always beneficial, paying from the invoice order and then paying from the salary, because you save employees NI and employees NI, employees and employees NI on the umbrella payslip. So it depends on the umbrella company that you're using, Rajiv.
So in first option, out of these two, can we dictate the umbrella company for deduction of amount? For example, I said I'm getting 10,000 and I said deduct 500 straightforward pay to my pot.
Yeah, you can. Yeah, you can.
Okay.
You can. So you need to really go back to and check with the umbrella company. A lot of the umbrella companies are doing this. There might be additional admin charge, but you can dictate that.
Okay. And similar one, another one very small.
Yep.
I have two pension company. Somehow my previous agency umbrella company is paying in two different. One is in Nest, one is in the Smart. So can we merge, or is it better to keep two separate?
One is on Nest, one is Smart. The issue merging, you can do it. Nothing stops you from doing it, Rajiv. But you're going to pay a lot of money to IFA because the mergers need to be signed off by an IFA. So they charge money. So if I was you, I'll just leave it as it is for the moment. But there's lots of changes happening in the regulations. At the moment in the banking, there's something called open banking, where the information feeds into different softwares for you to view the bank statement. That's happening in pensions also. In 3-4 down the line, the government wants everybody to have the right to view their pension wherever the pot they are. So you should be able to have app to see where the pension pot, and the moving should be quite straightforward. So that law is not there at the moment, but that's happening in 3-4 years down the line. So if I was you, I'll just keep it, save the money, and the law changes, you should give the flexibility to move the funds across.
So what is your suggestion? I mean,
if I was you, I'll just keep it as it is, Rajiv. I wouldn't merge at the moment, because effectively it's two platforms that you're managing. But in future, when the law changes, when there's a flexibility to move, I would just do at that time. If not, you're going to pay a lot of money for IFA to do this for you.
Okay. Thank you very much.
That's okay. Okay, moving down to EIS, CIS, and BCT. So when I speak to a lot of the clients who are IR taxpayers, a lot of them people don't want to put money into pension because none of us think we are getting any old, so they don't want to put money into pension and wait for 56 years to take 25% or 67 to access the whole pension, because it's not liquid enough. So the one thing they ask is, are there any other ideas to have liquid kind of investments? So one of the key things that you can utilize is EIS, CIS, or VCT. So these are like a venture capital startup, high risk funds where you can invest some of the money. Then for the investment that you're making, you can get a tax relief. So EIS is investment scheme. If you put, like, for example, 10,000, you get 3,000 relief. If you put onto CIS investments, you can get 50% relief, and on VCT, you get 30% relief. Obviously, there are caps of how much you can invest. You can see 1 million for EIS and 200,000 each for CIS and VCT funds. You don't get any tax relief on dividends for EIS and CIS, but you get the dividend income on those shares exempt from VCT for the VCT shares. And the capital losses are available for EIS and CIS. If you put 10,000 and company goes bankrupt, you can get a relief for that money that you lost on your tax return. Whereas on VCT, you don't get that one. Capital gains tax free. I have few people who invested in some of these startups and made significant amount of capital gains, and all three schemes, allows you to take that as a tax free, treat that as a capital gains tax free. For EIS, CIS, main difference is you need to keep the shares minimum of 3 years. Inheritance tax relief on EIS and CIS is available, not on the VCT though, right? That's important to remember. And one of the main questions people have is, okay, when they come to EIS, CIS, do they have to invest on one company or two companies or whatever? There are funds that's out there where you can invest in EIS funds or CIS funds, which is better portfolio manage it. So, rather than investing in one particular company, that might have a fund for 10, 20 companies together. So then, even if one company goes down, you can make a gain on the other company. So, if you need any help on that one, please reach out to us, and we can help on that one too. We can introduce to one of our IFAs who can have a chat and introduce to these schemes. Special tax implications I briefly covered on capital gains tax earlier, and also if you're thinking about selling your second home, etc. The capital gains tax on the second home was 28%. That got reduced to 24% to encourage people to sell their second homes. And if you have a furnished holiday lettings, it's get treated as it used to be get treated as like a business at 10%, but that's also now 24% like a second home. High income child benefit charge. So for long time it was 60,000. That got increased to 60,000 on the budget last year. But if you earn more than 60,000, you need to pay some of the child benefit back, right? So for 24-25 years, if you earn £25 for the first child and 16.95 for second child, if your income is 60,000, you don't repay that back. But if your income is 70,000, you can say you need to repay 50% of the money that you claim back to HMRC. So it's important if you're getting child benefits again. If you earn 62,000 or 65,000, worth putting the 5,000 extra to pension to give the full child benefit to yourself. Non-domicile, non-dom status, it's only a UK concept. So it's basically what it says is if the tax residency is based on the residency, not based on citizenship or not based on passport that you have, etc. It's about where you mainly live and where you mainly pay taxes. So if you mainly live in UK, but whether you have an Indian passport, a Pakistan passport, or a USA passport, money that you earn on that company, you need to pay tax in UK for that one, right? Even though you're a non-domiciled to UK, meaning that you are not born here, you associate your home to be outside UK, even though you're non-dom for UK purposes, but you're a tax resident in UK, you need to pay tax on the foreign income in UK. But if you are a non-dom, you can choose not to pay tax on the foreign income if you use something called remittances basis or rising basis. But important, remember, if you use a remittances basis, you lose that 12,570 tax-free allowance. So if you want to keep that tax-free allowance, it's best to use the rising basis, meaning that if you have foreign income, such as interest income or small rental income, it's worth disclosing that on your tax return. And you can get relief for double tax treaty agreement. For example, India and UK has a very, very generous double tax treaty agreement. So it's about disclosing, and you might not even pay the tax. It's about the disclosure. So if you have foreign incomes, please speak to us. And it is a complicated thing to understand, the non-dom, dom, and all that. But don't worry too much about it. Leave it to us, and we will take care of it. The important part is disclosing. In UK, it's called self-assessment because they expect you to do a very honest job of disclosing, self-assessing yourself. So if you don't do that, then the penalties are high, and the non-disclosure penalties are very, very high, and then you might not even have tax to pay, but you might have the penalty to pay before not disclosing. So it's important you disclose this in your individual tax return. As I told you, the final requirements: if you're submitting a paper tax return, you need to do it by 31st of October. If you're submitting online, 31st of January. Payment deadline is 31st of Jan, again, same date as the submission. The payment on account, if your tax bill is above £1,000, I always get this question about payment on account. If your tax bill is above £1,000, HMRC will assume you're going to get the same tax next year, so they'll ask you to pay something in advance, and that advance happens in 2 times, one in January, one in July. So that's why I said if you file the tax return soon after April, you know the exact amount of tax that you need to pay, so you can pay everything by July and then finish off the matters rather than waiting for January following year. Missing deadlines, obviously there's penalties and interest to pay, and the interest used to be very low in UK a few years ago, but I'm sure from your mortgage rates, the interest is very, very high when it comes to HMRC now. So it's important that you pay on time. And if you are struggling to pay, HMRC very, very relaxed about setting up a payment plan. So you can always call and set up a payment plan with them. And obviously they charge some interest, but it's better than significant interest they'll charge you for non-payment. Common mistakes to avoid, as I told you, missing the deadlines, make sure that you submit on time, come back to us on time. Inaccurate information, please double check the information, before submitting it or before approving it. Omitting income, so knowingly avoiding the income that you're earning, that's also wrong. And neglecting deductions, there might be very reasonable reductions you can claim, and you might have forgotten to claim that. So, make sure that, you claim all those expenses before the thing. That's about it.